So today we're going to talk about what it means to be a broker-dealer rep in the world of raising equity for syndications and other things. I have with me an old friend, Taylor Loht, who's going to delve deep into this topic with us. Taylor, welcome.
Thanks so much for having me today. It's great to speak with you again.
So what exactly is a broker-dealer rep?
So basically, we help operators raise capital for their syndications, their securities offerings under the supervision of a broker dealer. And I made the decision to get licensed because after being a general partner in a few syndications, I wanted to specialize on working with the investors on the equity side of things. And I noticed years ago that there were a lot of people who were essentially engaging in unregistered broker dealer activity that flies in the face of securities regulations that anybody who's learned about how this space works could see and kind of see the cracks in. And that never made sense to me because I wanted to build a business around being sustainable and not having to look over my shoulder, being able to sleep at night, and in terms of compliance and everything like that. So if you want to raise capital, there are really two ways to go about it. You can get licensed as I did, or a lot of folks have also started their own funds of funds. I decided not to go that route because I saw it as an additional administrative headache, and just a lot of other issues there. So getting licensed made the most sense for me. It's been a couple of years now, and I found it an effective way to gain access to more deals, to help our investors get into what I consider to be great deals. Of course, they're making their own investment decisions. We don't provide advice or guidance. And yeah, I think we have a lot of opportunities in the market generally heading into 2024.
So there are a lot of people out there, frankly, most of the people that I know who are raising capital are not licensed broker-dealer reps. I know you're not a lawyer, but you are a broker-dealer rep. You've gone through the licensing process, so you know a little bit about this. Can you talk a little bit about, the issues around raising capital, how to do it legally, why you need to be a broker-dealer rep? I mean, sort of all just that whole penumbra of issues, if you want to talk about that a little bit.
Sure. Again, mentioning not a lawyer, just a person who's engaged in this space. So syndicators, when they raise money, they issue a security and they sell those securities to investors. And for those who are, actively engaged in the general partnership, finding the deal, running the deal, everything like that, it's all good. You can pretty much go sell securities to qualified investors under 506B and 506C, follow all those rules, and you're good to go. But a lot of people want to be in the space and raise money for deals and get paid to just raise the money and not operate the deals or issue the securities. And they're not doing it in a compliant manner because in order to get paid for just the sale of the security, you need to have a license and be monitored and be with a broker dealer and everything along those lines. And I haven't seen, I have to think about this for a second, but I haven't seen enforcement actions by the SEC. There have been letters sent out over the years to folks who were maybe being unregistered broker dealers, letters sent out by the SEC saying, hey, we're going to look at what you're doing and see if it's compliant. And, again, that never sat well with me. I like not getting letters like that and playing by the rules as I understand them and doing my best to understand them. So from our perspective, and I think in this space, there's just a relatively clear set of rules that you need to abide by in order to raise money for other people's deals, essentially, in order to raise money for operators and have all the adequate disclosures in place and everything. So I hold two securities licenses, the Series 63 and the Series 82. The 63 deals with state securities rules and regulations, and the 82 is private placements. That's really where the syndication space is in that 82. And there are a lot of other securities license options out there and tests that you can take. I did the ones that my broker dealer told me I needed to do, right? I don't know what the other ones are. I just took the tests I was told to. And if I was told I had to take other ones, then I would do it. It's not that big of a deal. That process took from deciding that's what I wanted to do and taking 3 tests, actually to take 3 tests. First is the SIE, the Securities Industry Essentials, that qualifies you to take the other tests basically. And you can just go, anybody can go take that test. That one took a month or two to study for or so. And then heading into the 63 and the 82, each one of those probably took 2 months to study for. I worked really hard to study for those because I only wanted to take them one time. I didn't want to fail either one and have to go back, because if you fail and have to retake, there's waiting periods. If you fail a couple times, you might not be able to ever take them again for a couple months or years. So for me, it was just easier to put in the work and pass the test the first go around. So, that's what I did. That was a couple of years ago now, pass those tests, and there are continuing education requirements and everything along those lines that FINRA notifies you about, and the broker dealer is responsible for monitoring and everything along those lines. But as I mentioned, it's really helped us and helped the business gain access to more deals and bring what I consider to be better deals to the table for our investors.
And so you keep on talking about my broker dealer. What is that all about?
So the broker dealer that I'm currently with is Finalis Securities. You can go to FINRA Broker Check and punch their name in, or punch my name in, and see all the history. They essentially monitor the securities transactions. They monitor the individual reps' behaviors, if you will, marketing materials, our brokerage accounts. These are all requirements by FINRA. They monitor our emails to make sure we're not saying inappropriate things to investors. There's really quite a lot to it on the back end that once I started taking the tests and getting licensed a couple of years ago, demonstrated to me how much, frankly, I consider the syndication space, without FINRA looking over your shoulder, to kind of be the Wild West. There's so much going on in the syndication space that I wouldn't be able to do as someone who's licensed. That someone who's issuing a security can say a lot more things about a deal than we can say in terms of potential return projections or what FINRA might consider to be promissory language. I want to make it clear, I certainly do not speak for FINRA or a broker dealer in this regard. But the point being, the syndication space, the 506B and 506C, someone who's issuing a security and raising capital to investors without a broker dealer involved, you can do a lot and say a lot as long as your securities attorney goes along with it. That once FINRA becomes involved and there's a third party, essentially, which is us raising capital for the transaction, there are a lot more rules around what we can and cannot do. So I think it's all about protecting the investors at the end of the day.
So I'm curious, like what kinds of things are you not allowed to say?
So
are you essentially in a situation where you get the deck from the sponsor of the deal? Are you just pass it on? That's without, is that all you're allowed to do? Or like what? I mean, explain to me a little bit more about this.
Sure. Those things have to be reviewed and approved by the broker dealer. Looking at a big one that is very, very common in the general syndication space that we can't do, deals with potential return projections. So the syndication space, at least before interest rates started going up, was very obsessed with the metric of IRR. IRR is a really big one that personally, I think most people don't really understand how IRR works, and they see it more as something like a compound interest. But you can't eat IRR. You can't really project your overall returns by looking at an IRR. But FINRA is quite clear that IRR is not an approved thing. It's too much of a forward-looking projection, essentially. And they've put a lot out there that folks can Google just FINRA IRR. There's a release specifically about IRR, but a lot of it has to do with again, promissory language, saying something is low risk. Well, are you really disclosing all the risks? Who's to decide whether something's really low risk or not? Or, again, return projections saying, it's in the future. How in the world can you reasonably predict the future? Investors need to do that on their own. So there's so much more involved that, is honestly on the broker dealer to do their review. But when it comes to a presentation deck, a slide deck for a deal, we do have to basically have our own special slide decks that a couple of slides are different. mostly dealing with things like return projections.
So what if you're a sponsor and you bring in a licensed broker dealer rep to raise money for you, does your whole offering become regulated by FINRA, or only insofar as the broker dealer is showing that deal to their list of people?
So this is going to be my understanding here. Again, not a lawyer,
Hmm.
but from my understanding and my experience, it's just been the securities that pass through the broker dealer and that the broker dealer rep itself deals with. They don't, and we do a portion of every deal. We don't do the entire thing, and you wouldn't want to do the entire thing. You wouldn't want to do a deal with an operator that couldn't raise capital on their own, because how in the world could they manage that capital if they can't raise at least a portion of it on their own? But in my experience, it's just the securities and the investors that we deal with. It's not the entire deal.
And then I'm curious about this other thing, which is when so you're, are you essentially, for lack of a better, this may not be the official thing, but for lack of a better, or, sort of layman's understanding of it, are you essentially like an independent contractor and you have a license listed with your broker dealer? So it's not like you're bringing deals to your broker dealer, right? I mean, you have your own business, your own list of investors that you're showing deals to, but you're under the oversight of the broker dealer to make sure you're doing things appropriately and in compliance with the law. Is that the correct understanding? You're not like working with a whole bunch of other reps and bringing all your deals into your broker dealer and all the investors all get to see them, or does it work that way? I don't know.
So we do have a group of reps that we all work together on deals, because that enables us to all bring more capital to the table together. But the deal does have to, and the slide deck and everything like that does have to be reviewed by the broker dealer to check it out. And we go further than that, doing background checks on sponsors to make sure they're legitimate, because at the end of the day, we're not running the deal, but it is our reputation, right? We're hands off when it comes to the actual, success of the opportunity. But, I feel I have a duty and responsibility to my investors to do that vetting of the operator of the deal to make sure they're legitimate and it's a real opportunity. That doesn't, investors are on their own to assess whether it's the right fit for them and everything along those lines. But I think to anyone who is experienced in the syndication space, been around for a few years, done some deals, and is networked and paying attention to the conversations happening in the back room, if you will, amongst syndicators that are not public conversations, you can learn a lot more and see a lot more red flags in deals. I'd rather not do a deal than to do a deal that I personally don't have a good feeling about, whether it's from the ethics of the operator or even if their ethics are good, their ability to execute on their business plan, whether I think it's appropriate, because at the end of the day, it's tied to us in some way, right?
But just further on this previous point, just because I'm curious. So let's just to make this really simple, there's 5 people in your broker dealer. You each have 100 of your own clients. When you have a deal come in, is it only going to Taylor's 100 clients, or is it going to like all 500 clients of the firm? Assuming that this is the way it works, and I don't know, but I'm just curious.
Yeah, no, it's everybody's decision, right? If I had a deal that I didn't want to share out, then I don't have to.
Mm-hmm.
Now, the odds are low that I wouldn't want to share it at the end of the day. I mean, I want these deals to be successful, but once it's on the broker dealer platform, if you will, it's considered a mandate. This is one of the terms that they use. It's the mandate owner, quote unquote, the person who brought it to the broker dealer. It's their decision, along with the issuer. Of course, it's always their decision if they want to open it up to other broker dealer reps and everything, whether you want to be just with one and only have the option of one rep's investors, or if you'd want to open up to all of the other folks who are BD reps on that particular BD platform.
And then in terms of managing the communications with investors once they're in the deal, does that go through the broker dealer, or are you kind of out of the picture at that point?
We handle all that. I'm on the ride the whole way.
So meaning that if the sponsor then sends you the communications for the people who came in through you, and then you are communicating with them. Is
That's
that how
right.
it
And
works?
it depends on the nature of the communication. If it's a K1, for example, K1's going directly from the operator. It's not something that we're going to handle. When it comes to things like the funds, the wiring of the money or the agreements and everything, all those agreements are between the investor and the syndicator. They're not with us. When it comes to wiring the money, I never touch the money. Doesn't come to me. I don't want it. It goes from the investor to the syndicator. We're just helping facilitate that agreement, if you will.
What about sort of like monthly updates and those kinds of communications?
We handle that.
And then what about the compensation? Like how is a broker dealer typically compensated for raising the capital?
Typically, it comes out of the general partnership. So any syndication is going to have an acquisition fee, and then there's a GP LP split. And a very common way to break that up is a GP might have it might be 70-30 or 80-20. If you have 30% or 20%, might break that GP ownership up into thirds, a third dedicated to deal sourcing, asset management, or 2/3 dedicated to those items, financing, the operational side of things, and then the remaining third dedicated to capital raising and sourcing, split up based on who brings dollars to the table. Excuse me.
So the licensed broker dealer reps are participating in the GP as well as getting a piece of the acquisition fee.
And yeah, non-voting GP membership, essentially performance on the back end.
Got it. So let's talk a little bit about how you got into real estate in the first place. We've talked a lot about where you are now, but how did you get here?
So my investing journey, my wealth building journey, if you will, starts all the way back when I was in high school and I had a job at Sears, back when Sears actually existed, making, I don't know, $6-7 an hour or something like that. And had a little bit of money coming in high school. I was like, how can I turn this into more? I don't know how. Right. And my wealth building toolkit was incredibly limited at that time. So this was back before the Great Recession when you could get some interest in a bank account. So that was what I did is I found the highest interest rate bearing account that I could. And that's all my toolkit was. But then I got older, grew up, started making more money, got out of college and everything. And it was like, okay, I have more money now. How do I grow it? How to turn it into more? I was listening to podcasts at the time, and they introduced me to one of these books over my shoulder, The Intelligent Investor by Benjamin Graham. That's where I learned about value investing in publicly traded equities. So I started investing in the stock market and did pretty well with that over a few years, but I was seeing that it was taking me in a direction that I didn't want to go, and it wasn't taking me there as quickly as I wanted to get there. Basically, I wasn't able to add value to those investments, and they weren't providing cash flow. So I want cash flow at the end of the day. So listening to more podcasts, real estate investing podcasts, and happened to pick up another one of these books over my shoulder that everybody's read, Rich Dad, Poor Dad, learned about the power of cash flow, decided I wanted to get into real estate investing. A few more years went by. I realized that I really believe in multifamily as a way to create wealth and grow wealth. And there are a lot of other ways to create wealth in real estate investing. And I found that, okay, this multifamily syndication thing is a way to do deals with others who have skills and resources that I don't yet have, at least at the time I didn't have, and I can grow my wealth along with them. So I started as a passive investor back in 2016 when things were completely different than they are today. Went on to get on the GP side of things and a few syndications. A few years went by through that process, and then got licensed mid-COVID, if you will. So it's been a really interesting journey. The space has changed quite a lot in that time. We were saying before we started recording here, I remember you back in 2019 talking about all these multifamily guys. They're paying too much for these deals. They don't know that the wave is coming. Nobody saw COVID coming, let's be honest, but that may have kicked the ball for a few years for operators who were over leveraging and making assumptions that they didn't really understand. And I think having all of those observations, learning from people like you and so many others has helped me better inform my investing philosophy, if you will. So that's a, quick version of my investment journey.
Yeah, just as an aside on the 2019 thing, I mean, I do think that uh, COVID kicked the can down the road a couple of years, and a lot of the people who bought, the 2018, 2019 vintage deals got bailed out by the crazy prices that were paid during COVID. I think a lot of people who actually weren't making any money on deals sold and made a lot of money during COVID. And then the people who bought those deals are the ones who are getting foreclosed on now, unfortunately. But that's just an aside. But thank you for remembering what I was saying back in 2019. I
How could I
appreciate
forget?
that. So
You were, anybody who's seen Zoolander out there, if you think about Mugatu, Will Ferrell's character, yelling, I feel like I'm taking crazy pills. I feel like that was probably you every day back in 2019.
I thank you for equating me with Mugatu.
He is the
That's
villain of that movie, but still, it's a good phrase.
No, I mean, I did think that. I think I might have actually even thought of Mugatu and that very line sometimes, but probably more in about 2022 than 2019. And 2019, I was just really frustrated. But in any event, so I'd like to switch gears a little bit here. And, obviously you were deeply involved in the capital markets because it's all you do for a living is raise capital. I'm wondering, what have you seen change over the last, couple of years to the present in terms of, investor appetite for deals or the abilities or difficulty with which people are raising capital right now? Just speak a little bit from what you're seeing out there in the marketplace, kind of as a general proposition.
Sure. I did see a pretty significant wane in investor interest. And that's not just my business. It's talking with other people who are in the space and seeing the deals that they're doing and the difficulties that they're having raising capital in second half of 2023, if not maybe the last quarter of 2023. There was a big pullback, and I think there's a lot to that. There's a lot of talks about recession and the interest rates being significantly higher than they were. We've all seen the fairly high profile foreclosures that have happened in multifamily primarily, but they are happening in the office space as well. They're just not as spoken about in the space because we don't have a lot of uh, office investors that are in this syndication space that we're playing in, but they certainly are. They certainly are happening, and investors are seeing that they can get what is essentially a risk-free return in a bank account today between 5 and 6%, depending on where you go. And a lot of commercial real estate syndications from multifamily, but not just multifamily, self-storage, less so in industrial, but aren't going to cash flow that much in the first year, right? Because you're buying at a particular cap rate, you're going to invest money into the property to fix it up. So it doesn't make a ton of sense to be pulling out all the cash that you can and distributing cash flows. The cash flows tend to be lower in the first year. And combine that, what people can get as a risk-free return, or essentially risk-free return in a bank account these days, with all the talks of recession and the high-profile foreclosures that we saw early this year, mid this year. And then if you're really plugged in and paying attention, there are foreclosures happening in the background that people just aren't talking about quite as much. I just saw that pull back investor interest generally. I think that will return into the future, but you can't, blame investors for what they're seeing in the space. It's not hard to find things about, fairly high profile syndicators that have, say, paused distributions. Now, pause distributions can be a defensive measure. There are a lot of reasons why a syndicator might choose to pause distributions, but investors, they're smart people. Most of these investors are accredited, who earn a pretty significant income at their day jobs or have a, healthy personal net worth. They know what they're doing when it comes to investments. They understand their own risk profiles, and they're deciding, hey, right now is not the right time for me in this space due to uncertainty, what have you. I can maybe get a better risk adjusted return in other places, at least in the short term. So I'm just going to sit on the sidelines and decide, to keep an eye on it and see what's going to happen in the future. And, I see that happening all around. It's not just in the investment space, but also in the investor education space. I've had conversations with a few coaches and folks who are involved with coaching programs who have seen interest in those programs pull back pretty significantly. And it depends on the program and how much it costs and the figurehead involved, if you will. But many of those programs are having trouble getting new students these days. And that could be a sign of interest in the space. Generally, we can only collect the data and decide what to do with it, but it's on both sides. It's tough to do deals these days with interest rates where they are and property values where they are. There are deals happening for sure. There are a lot of folks buying properties now that are buying properties from distressed operators who are losing some, if not all, of their investor equity. It's an unfortunate situation, but those transactions are happening anyway. But the transaction volume is down. One of the numbers that I saw was around 75% in 2023 compared to 2022. So mix that all together, combined with, I think another thing we're going to see is more of a reversion to the mean in terms of hold times in not just multifamily, but the rest of commercial real estate. Typically, pre-COVID, folks would say, oh, we're going to hold 3 to 5, maybe 5 to 7 years, depending on the business plan. But during COVID, money was cheap and people were doing deals. Folks were holding 12 to 18 months. Their business plan was probably 3 to 5 years, but they were able to earn the projected return in 18 months. So take the money and run. Well, as rates are higher, there's a debate whether rates are going to come down in 2024. I try not to read those tea leaves because nobody really knows. I don't think even Jerome Powell knows if rates are going to come down in 2024. But mix all those things together. People are just deciding, I'm going to sit on the sidelines and see what's going to happen. And, it just is what it is.
So are you seeing people who are doing deals, is the issue that they're not able to raise enough capital to close, or is it just taking them a lot longer than it had been to get across the finish line?
So personally, I haven't seen anybody fail to raise their equity yet. I'm sure it's happening. I can't speak to that. I just haven't seen it personally. I've just seen things take a little longer than they used to. It depends on if you were a new entrant to the space and just doing your first capital raise, you might be struggling. The folks that I choose to do business with are much more established and do have that ability. So we haven't seen that happen, just taking longer than it used to. But, that is a data point.
Are you seeing deals get extended so that people can complete their raise, or is it just that people are more kind of working harder and getting closer to the wire on their fundraise?
So in my experience, has been working harder and getting closer to the wire. We haven't had any extended yet, but again, I'm sure it's happening. I can, again, reading the tea leaves, I think I can see that happening. But for us, it hasn't resulted in extensions or failures to close yet.
Yeah. I mean, I've seen a couple of instances where the funds for close have been raised, but the fundraising has continued past closing to round out the capital for the renovations and stuff like that.
Yeah. A lot of times, depending on the sponsor's balance sheet, which is a huge topic. Some sponsors are just having to bring more of their own capital to the table, which isn't the end of the world. I think that's something that investors up until now haven't thought about enough, is the young guys who are syndicating their first property and, might have between the whole team $1 million to their own name, but they're doing a $15 or $20 million deal. Well, do they have the personal balance sheets to get it to close if they have trouble raising, or to help the deal out if it struggles? I think it's a big consideration that not enough folks think about, or at least haven't thought about enough historically, that, hopefully they are thinking about more moving forward.
So, any other thoughts that you have on either the markets or the broker-dealer business in general that you think people should know or would benefit from hearing about?
So from my perspective, getting licensed has been really interesting, great opportunity. And the biggest surprise to me, honestly, was how many operators, once they find out that I'm licensed and I raise money for deals and have this network and everything, how many are really interested in working with someone who is licensed and can do it legally, as long as all the boxes are checked. In hindsight, it shouldn't be that big of a surprise because, deals need equity in good times and bad. And sponsors are always looking for more and better options. Even really established sponsors with the ability to raise all of their own capital realize that they should have multiple options, and they want to make sure it's it's compliant as possible. So that's been a really interesting surprise to me. I see my participation in the real estate space and in wealth building generally as a long-term thing. I'm 34 and I intend to be investing for the rest of my time alive. So I don't focus too much, or I don't worry too much about short-term ups and downs. I think as long as we're doing deals that will continue to cash flow into the future, then we're in a good position. I think too many folks, getting back to the topic of educators and coaches having a hard time bringing people into their programs, whether those are a good move or not, I'll set to the side. They're having trouble because folks want that quick fix. They want to get into the syndication space, do one deal, and be able to retire. They see it as, on the operator side, I'm going to sit on the sidelines and see what happens. But if you want to build a real estate investing business on the active side of things, you need to just get started. That doesn't mean necessarily just go do a deal in any deal that you can find, but get into the space, go network, start a podcast, get educated, read books, go to conferences, build your own meetup, all the things that you can do to continue to start to grow your business. Don't wait to do those things. And I'm saying this because I'm somebody that I, especially early on, tended to wait on making those decisions and taking that action because I was concerned about doing it exactly right, or I don't know exactly what I'm going to do. You want to build that business, you're only going to find out what the right move is by doing it and figuring it out and correcting along the way.
That's absolutely correct. I mean, I can't agree with that more. You learn by doing, not by thinking about it or reading about it. I mean, you can learn a little by reading about it, but it's never the same thing as actually getting into the trenches and, you know, having to figure it out as you go. It's funny, just moving back to something you just said. I'm actually quite surprised, now talking with you and some other people we know in common about this about becoming a broker dealer rep. I'm just really surprised that not more people are doing this, right? Because like you said, it just clarifies all of this murky legal stuff, makes it clear that you're on the right side of the law when you're raising capital. And it doesn't seem to me to be overly difficult to get licensed properly, in which case you're doing everything above board. So I'm really surprised more people don't do this. I mean, just as you said a moment ago, when you speak with sponsors who, when they find out that you're licensed, become very interested. I mean, I definitely have that feeling too. It's like, oh wow, this is just so much better a way to do it than to have to worry about, like, are you kind of jumping through the right hoops with your structure of your partnership to make sure that this is in compliance, um, rather than just having it be just not an issue, right? When you work with someone who's licensed.
Well, I think there's a lot to it. I think folks probably aren't aware that it's available, that you can do this. I wasn't, and then I became aware, so I did it. But once you dig into it, it's not easy and it's not cheap to do, right? You have to be willing to study for and take those tests. The tests themselves aren't expensive, but the study materials, I think I spent about $1,000 on the study materials. They're not necessarily cheap. And then I had to dedicate a healthy amount of my time to studying for those exams. And then once you're on board, there's continuing compliance involved, right? They're pretty involved with what we do and looking over our shoulders. And like I said earlier, after going through this process, I really kind of consider a lot of the syndication space to be a bit like the Wild West. And I certainly believe in the free market, but it just, it has demonstrated to me more how many operators make a lot of promises that they might not be able to follow through with, or tend to make projections that maybe aren't in line with reality. And having a more objective view on that, I think, has been interesting to see. So there's a lot to it. I think folks who want to be involved in this business in the way that I am should consider it. Go down the route. Look at what's involved, and if that's what you want to do, commit to it. But realize that it certainly is a commitment.
Yeah, well, I've seen the world evolve, since I got into the business, and now what you see is maybe a small but growing number of people like yourself getting actually licensed. But the current state of the capital raising seems to be, all right, you're going to make somebody a partner and make sure that they have the appropriate duties outside of just raising capital so that you're compliant. But when I started out, there were just literally guys running around saying it's a 3% fee. I'll raise equity for you, pay me 3%, and that's it. And they really were like unlicensed broker dealers with not even really making any attempts to join the GP, to like become partners, to try to be compliant. They just said, oh, just call me a consultant. call me a consultant on the settlement statement, and that'll be fine. And I didn't deal with any of those people. But they were certainly like reaching out to me once my name got out there that I was in business. So I don't hear from any of those people anymore. But I do, maybe in general, things are kind of moving more in a compliant direction than they were when I started out, but they're still not quite there yet.
I agree. And there are not only broker dealers, but as mentioned before, fund of funds has become popular. There are a lot of platforms and companies that will help you open your own fund of funds. The compliance side of things is on you, and hire an attorney and everything. But when I started in the space as a passive investor and then got onto the GP side of things, that didn't exist. Things like all of these investor portals that everybody has now. I have one now. Everybody has one. They didn't exist, and they were a huge hole in the market. There were a lot of, maybe I shouldn't say a lot, a handful of syndicators that I'm aware of who basically had money lost because somebody compromised their email, a hacker compromised their email and sent the wrong wiring instructions to investors. That is unfortunately probably still happening, but you don't hear about it as much because these portals have added a lot of security to the space. So as these services have popped up, these B2B services have popped up to help the space grow, I think that's just made things better, but it's a lagging indicator, if you will. The business, the industry has to exist before tech entrepreneurs and all these companies will pop up to service the space. And that's happened. And I think more great things along the way. Who knows what AI is going to bring? AI's made production of my podcast a lot easier, putting out social media posts and everything like that. That's helped a ton. And I think we're just barely scratching the surface on what that's going to bring in terms of maybe legal doc review and prep. I mean, who knows? But there's a lot of exciting things on the horizon.
Well, on that note, if people want to get in touch with you, Taylor, and join your platform or just learn more about what you're doing, what's the best way for them to get in touch?
Sure. You can go to investwithtaylor.com. I'll happily schedule a call with any of your listeners out there, or a free thing I could give away, if that's all right.
Yeah, absolutely.
7 red flags in passive real estate investing. Just go to passiverealestatecourse.com. Totally free, no pitch, just trying to add value to folks who are interested in learning.
Well, everyone, absolutely go download that free course. Can you give the name again?
Sure. passiverealestatecourse.com. I was shocked that URL was available.
Well, I'm glad you grabbed it. Everyone go grab that download. And Taylor, always great talking to you. Thanks for your time today. Really appreciate it. And looking forward to speaking again soon.
Thanks for having me.